Credit spreads just exploded to 12% in the United States, while London credit markets hit 18%. These represent the highest credit risk premiums since the 2008 financial crisis and signal systematic credit market collapse, where lending becomes impossible while existing positions trap lenders in unrecoverable losses. This is the credit spread blowout, and it's over. Let me show you exactly what credit spread explosion means for the global financial system. Let me walk you through the mathematical impossibility of lending at these spread levels, and let me explain why lenders are completely stuck with no exit strategy, while borrowers face financing costs that eliminate business viability and economic growth. Because when you understand credit spread mechanics, when you see the historical precedents, when you recognize the feedback loops, you realize this is not market volatility. This is systematic credit system collapse, where lending stops completely and recovery requires years of deleveraging and restructuring. The credit spread crisis is not temporary. The credit spread crisis is terminal. Every credit crisis in history followed identical patterns through spread widening that made borrowing impossible, while forcing lenders into loss positions that eliminated lending capacity. The 1929 credit crisis saw spreads exceed 15% before banking system collapse. The 2008 crisis reached similar levels before government intervention prevented complete system failure. Current spread levels exceed 2008 peaks, while government intervention capacity remains limited through existing debt levels that prevent massive bailout programs without triggering currency crisis and inflation acceleration that makes intervention counterproductive. Credit spread measurement represents the additional interest rate premium that borrowers pay above risk-free government bond rates to compensate lenders for default risk, liquidity risk, and market risk that varies with economic conditions and borrower creditworthiness. Normal credit spreads range from 1% to 4% for investment-grade corporate borrowers during stable economic periods, while high-yield borrowers pay spreads of 4% to 8% depending on credit rating and market conditions. Current spread levels of 12% for U.S. corporate borrowers and 18% for London markets represent default probability pricing that makes borrowing economically impossible for most business operations, while indicating lender expectation of systematic defaults across multiple industry sectors. The spread explosion occurred over 6 weeks through systematic deterioration in credit market conditions triggered by banking sector stress, corporate earnings declines, and economic growth concerns that created self-reinforcing cycles of risk premium increases. U.S. investment-grade corporate spreads increased from normal levels of 2.5% in September to current levels of 12%, representing nearly 5 times normal risk premiums, while affecting companies previously considered creditworthy borrowers. High-yield corporate spreads exceeded 22% for lower-rated borrowers, while many companies face complete market exclusion, where no lending is available at any price, creating immediate liquidity crisis and bankruptcy risk for leveraged businesses. London credit markets deteriorated more severely through European banking stress and regulatory uncertainty, while pound sterling weakness created additional currency risk that international lenders demand compensation for through higher spread requirements. European corporate spreads reached 18% for investment-grade borrowers, while high-yield markets essentially closed, with spreads exceeding 28% for available financing that remains extremely limited in volume and duration. The mathematical impossibility becomes clear through business cash flow analysis that shows typical corporate operating margins cannot support debt service costs when credit spreads exceed 10% while maintaining viable business operations and investment capability. Manufacturing companies generate operating margins averaging 8 to 12%, while service businesses achieve margins of 6 to 15%, depending on industry sector and competitive conditions that determine pricing power and cost structure flexibility. Debt service requirements at 12% credit spreads consume entire operating margin for most businesses, while eliminating working capital for operations, equipment replacement, and growth investment that maintains competitive positioning and employment levels. Small and medium businesses face immediate bankruptcy risk, because operating margins typically range from 4 to 8%, while credit access at current spread levels requires debt service payments exceeding total business profitability. The lender trap develops through existing loan portfolios that cannot be sold or restructured, while new lending becomes impossible at sustainable risk-adjusted returns that institutional investors and depositors require for capital allocation. Commercial banks hold approximately $4.2 trillion in corporate loans while facing systematic default risk when borrowers cannot refinance maturing debt or service existing obligations at current spread levels. Regional banks face particular stress through commercial real estate lending exposure, while construction and development loans become worthless when projects cannot obtain takeout financing at economically viable rates that support property values and debt coverage. Insurance companies and pension funds hold massive corporate bond portfolios that face systematic value decline through spread widening while new investment opportunities disappear when yield requirements exceed borrower payment capacity. Private equity firms cannot exit portfolio investments through debt refinancing, while acquisition financing becomes unavailable at any reasonable cost, creating systematic illiquidity across leveraged investment markets. The refinancing wall represents systematic maturity concentration, where existing debt requires replacement at current spread levels that borrowers cannot afford, while creating default cascades across multiple industry sectors and credit rating categories. Approximately $2.8 trillion in corporate debt matures over the next 18 months, while refinancing at current spread levels would require debt service payments exceeding borrower cash flow generation capability. Investment-grade companies face downgrades to high-yield status when credit metrics deteriorate, while high-yield borrowers face bankruptcy when refinancing becomes impossible at survival spread levels that maintain business operations. The economic implications include systematic business failure through credit access elimination, while employment decline accelerates through business closure and investment reduction that affects economic growth and tax revenue generation. Corporate capital expenditure declines through financing unavailability, while equipment replacement and facility expansion stop creating productivity decline and competitive disadvantage that reduces long-term economic growth potential. Mergers and acquisitions activity ends through financing elimination, while strategic restructuring becomes impossible when debt markets cannot support transaction requirements that depend on leverage for economic viability. Initial public offerings and secondary equity offerings face market rejection, while investors demand risk premiums that exceed expected returns from business operations during economic uncertainty and credit stress periods. The employment implications include systematic job losses through business failure and investment reduction, while remaining companies reduce workforce to minimize fixed costs during revenue decline and financing stress. Construction and development employment faces immediate elimination through project financing unavailability, while commercial real estate activity stops creating multiplier effects across equipment, materials, and service industries. Manufacturing employment declines through business closure and production reduction, while export competitiveness deteriorates through increased financing costs that raise product pricing above international competition levels. Service industry employment faces systematic reduction through business failure and location closure, while discretionary spending decline reduces revenue generation capability across retail, hospitality, and professional service sectors. Government fiscal implications include tax revenue decline through business failure and employment reduction, while social spending increases through unemployment insurance and assistance program demand that creates budget deficit expansion. Municipal bond markets face systematic stress through tax base erosion and economic activity decline, while infrastructure maintenance becomes unfunded through revenue reduction and borrowing cost increases. State government budgets face systematic pressure through corporate tax reduction and individual income tax decline, while education, healthcare, and public safety spending requirements continue despite revenue shortfalls. Federal tax revenue faces systematic decline through corporate income tax reduction and capital gains tax elimination, while transfer payment requirements increase through unemployment and social assistance program demand. The international implications include trade finance elimination through credit unavailability, while international business activity declines through financing cost increases that make cross-border transactions economically unviable. Export financing programs face systematic stress through government budget constraints, while private trade finance providers withdraw from markets where credit spreads exceed transaction profitability and risk tolerance levels. Foreign exchange markets face systematic volatility through credit crisis contagion, while currency stability depends on economic fundamentals that credit system collapse undermines through business failure and investment reduction. International investment flows reverse through credit market stress, while portfolio managers liquidate positions to meet redemption demands and avoid further losses from spread widening and default recognition. Central bank policy responses prove inadequate because interest rate reduction cannot address credit spread problems, while quantitative easing programs face political constraints and inflation risks that limit intervention effectiveness. Federal Reserve emergency lending programs provide temporary liquidity but cannot address fundamental solvency problems when business cash flows cannot support debt service at any interest rate during economic contraction periods. European central bank intervention faces political opposition and legal constraints, while member country fiscal positions prevent coordinated response that would require massive debt monetization and currency debasement risks. Bank of England policy options remain limited through inflation concerns and currency stability requirements, while UK economic conditions deteriorate through Brexit effects and international competitiveness decline. The historical comparison reveals current credit spread levels exceed most previous crisis periods, while government intervention capacity remains constrained through existing debt levels and inflation concerns that prevent aggressive monetary expansion. The 1929 credit crisis required 4 years of deflation and business failure before credit markets stabilized at sustainable spread levels, while unemployment reached 25% and economic output declined 40%. The 2008 crisis resolved through massive government intervention and Federal Reserve asset purchases, totaling over $4 trillion, while creating debt levels that prevent similar intervention during current crisis conditions. Previous crisis resolution required systematic business failure and debt restructuring, while current debt levels and economic complexity suggest longer recovery periods and deeper economic contraction than historical precedents. The corporate survival strategies require immediate cash conservation and debt restructuring, while businesses that cannot adapt face bankruptcy within 6 to 12 months when cash reserves exhaust and credit access remains unavailable. Asset liquidation becomes necessary for leveraged businesses, while fire sale conditions reduce recovery values and create additional losses for secured lenders who depend on collateral values for loan recovery. Workforce reduction becomes immediate necessity, while businesses eliminate all non-essential costs and postpone capital expenditure to preserve cash during credit unavailability and revenue decline periods. Supply chain restructuring requires cash payment terms, while credit-dependent vendors face elimination, creating disruption across interconnected business relationships and geographic regions. The investment implications include systematic equity market decline through earnings reduction and business failure, while credit-sensitive sectors face particular vulnerability during spread widening and refinancing crisis. Financial sector stocks face systematic decline through loan loss recognition and business volume reduction, while regional banks face particular stress through commercial lending exposure and deposit flight concerns. Real estate investment trusts face dividend elimination and share price collapse through refinancing, inability, and property value decline, while construction and development companies face bankruptcy through project financing elimination. Retail and hospitality sectors face systematic business failure through financing unavailability and consumer spending reduction, while discretionary income declines through employment uncertainty and credit access restriction. Energy and industrial companies face operational constraint through capital expenditure, financing elimination, while environmental compliance and safety requirements continue despite reduced cash flow generation and credit availability. The consumer implications include credit access elimination through tightened lending standards, while mortgage availability declines through bank capital conservation and risk aversion that affects housing market liquidity. Credit card limits face systematic reduction, while interest rates increase through funding cost pass-through that reduces consumer spending capacity and discretionary purchase capability. Auto financing becomes unavailable for subprime borrowers, while prime rate financing costs increase through credit spread pass-through that affects vehicle sales and transportation options for middle-income families. Student loan availability faces systematic restriction, while private lending markets close, creating education access limitation and career development constraint for traditional college-age students. The recovery timeline requires systematic deleveraging across business and consumer sectors, while credit markets remain dysfunctional until debt levels decline to sustainable percentages of income and asset values. Business failure acceleration continues for 12 to 18 months, while viable companies reduce debt through cash flow allocation rather than growth investment, creating employment decline and economic contraction. Credit market normalization requires 2 to 4 years of systematic restructuring, while lender confidence returns gradually through demonstrated borrower performance and economic stability restoration. Economic growth recovery depends on credit system restoration, while productive investment requires financing availability at sustainable spread levels that enable business expansion and employment growth. The mathematical conclusion proves current credit spread levels eliminate lending viability while creating systematic business failure cascades that central bank intervention cannot prevent without massive currency debasement and inflation risks. 12% U.S. credit spreads and 18% London levels represent terminal credit system dysfunction, while lender trap conditions prevent normal market function restoration through traditional monetary policy mechanisms. Credit market collapse creates systematic economic contraction, while business failure accelerates through financing unavailability that eliminates working capital and investment capability across multiple industry sectors simultaneously. The credit spread explosion signals economic system breakdown where lending stops, business fails, employment declines, and recovery requires years of systematic restructuring that traditional policy tools cannot accelerate. It's over for credit markets at current spread levels. Lenders are trapped. Borrowers face impossible costs. Business failure is systematic. Economic collapse is inevitable. Recovery requires fundamental restructuring. This is not market correction. This is credit system terminal dysfunction. The spreads guarantee it. The mathematics prove it. It's over.